Good evening, everyone. Sorry for the slight delay, but thanks for turning up. We'll begin now. So tonight, Blueprint for Financial Success Module 3, and we'll be talking about the CPF system. All right. So same thing. Before I begin, whatever we mentioned tonight, please understand this is not financial advice. You do need to consider your specific circumstances before you do any major actions lah. Okay, so anyway, I won't go through the introduction. Most of you already know me. We'll just jump straight in module 3, understanding CPF, your partner in financial security. All right, so we'll be talking about the CPF system, which is something that as Singaporeans we would have, citizens and PR we will have it. I think it's it's an important system, so we should try and understand how it works so that we can maximize it better. All right. Okay. Yeah, just one more thing is everyone can hear me, right? You just want to do a sound check. You can hear me, just type something in the chat box. Okay, can. Thank you, Link. To the rest, I assume you can hear me. Okay. Uh all right. So let's carry on. Okay. So we'll be covering a few things tonight. First of all is the overview of CPF accounts, OA, SAMA. Okay, we'll understand how contributions work, how withdrawals work. Okay, and then of course I'll talk about CPF Live, which is a very important thing to know about. And after that we'll wrap up. And I believe at that point we'll also be sharing a little bit more on the portal. I'll let Darren do that. Okay. All right. So CPF. What's CPF? Okay, so CPF is a social security system. For those of you who know about the history of CPF, it actually was meant strictly for retirement. The other accounts actually only started to be introduced later on. In fact, MediSave account was actually introduced, the last of the major accounts to be introduced. That was in 1984. So, but CPF as we know it in the current iteration has been around for at least 30, 40 years. All right. So what's the point of CPF, okay, or Central Provident Fund? It's basically to ensure that when we retire, we've set aside our needs for for certain things in retirement, and namely three things as the government identified that everyone will need in retirement. First thing is a paid up home, right? Okay, so you can use CPF to buy a house. You can actually uh use CPF to pay off the loan so that by the time you retire, you would have a fully paid out home that hopefully the lease will also last you all the way until you don't think you'll be around anymore. Okay, second thing, medical needs. Okay, so healthcare is one of the most expensive things in Singapore, I suppose, especially when we age. So healthcare, we need to have preparations for our healthcare needs in retirement because people will only become less healthy with time, not more healthy with time. And of course, caregiving, which is why long-term caregiving when we are old, okay, we might need people to look after us, maybe because something has happened and we are no longer capable of looking after ourselves. So in this case, then yes, you need some kind of coverage to ensure that you can afford a caregiver. And lastly, when we are still blessed with health and longevity and vitality, you need money to spend. So CPF, when you retire, will give you stream of income for life. Okay. Keyword is when you retire. We are talking about when CPF expects you to retire. So of course, if you have ideas of like financial independence, retire early, and you want to retire earlier, then of course, CPF may not quite fit the bill. Okay. But nonetheless, if you retire at the age that the government thinks you should retire at, then yes, CPF will be there to give you a stream of income. Okay. So we got the three CPF accounts, okay, the ordinary, special, MediSave, and then of course the retirement account, which actually formed after you turn 55. And of course, I think this year the change has already kicked in. So after 55, when your retirement account is formed, then the special account is closed. And money from the special account will be moved to your ordinary account and any excess money that is, okay? And then that's basically your four CPF accounts. Okay, so they earn various interest rates. Ordinary account earns 2.5. Okay, special MediSave retirement earns 4 at this point in time. The interest rate is pegged to a formula. Okay, the formula is publicly made known on the CPF board website, so you can refer to that, but I will touch on it briefly later. Okay, so when we're young, we're working. Okay, we contribute to CPF. there is this thing called the contribution rate. Okay, so for most of us, we always say that 20% of our income is going to be contributed to CPF. But at the same time, okay, for most people, as long as you are below 55, your employer will add an additional 17%. Many years ago, I understand it used to be like 20% as well for the employer, and then it got cut back to I think like 16% and slowly raised back to 17%. So total 37% of your income will be paid into CPF. Okay, of which 20% comes from you. The 70% is just basically extra from your employer, which is still a good thing. Okay, and then as we age, once we go past 55, the amount we contribute in total will drop off gradually. Okay, reaching 12.5% if you are still working with CPF contributions after the age of 70. All right. Okay, but it's important to note that these numbers are subject to policy changes. Okay, so have there been policy changes? The answer is yes, there's been policy changes because starting from next year, okay, so we might as well talk about it. Starting from next year, nothing's changed for those who are age 55 and below, but later on, okay, when you're above 55, there's a slight increase. Okay, as an employee, okay, you as the employee would have to contribute 1% more, 18% now instead of 70%. But at the same time, the employer also has to contribute 0.5% more, and this would apply to people from 55 to 65. Above 65, there's no change. I think this is not actually a bad thing, honestly. You would have a bit more in retirement, a bit more for your contributions, which ultimately is still your money, right? So I think having this means that you would have more CPF savings accumulated by the time you retire. And it's not, I wouldn't think it's a very big increase, 1%. Okay, so that's what it will be from 2026. Okay, so a total of 1.5% points more. Okay, and it will compound, so I think that's a good thing. Okay, so how much can you contribute to CPF? So there is an overall annual limit, 102,000. Okay, this has no change. Even though over the past few years, the amount of salary that you had to contribute CPF on has increased in terms of your monthly wage. That has increased from 6,000 to currently 7,004. Okay, and then eventually from 1st Jan 2026, it will hit $8,000. So what this means is that if, let's say now it's 2026, okay, and you earn 8,000 a month, the entire 8,000 would be subject to CPF, meaning you will take home 6,006 because, no, 6,004 because $1,600 would be subject to CPF, 20%. Okay, so 12 months of salary means 96,000 would be subject to CPF. Okay, so that's what will happen, which compared to say 5 years before 2023, basically, if you were earning 8,000, okay, only 6,000 will be subject to CPF. So from 2026, you will take home 6,004. Okay, but before that, before August 2023, okay, if you were earning $8,000, the same $8,000, actually you will take home 7,002. Okay, wait, no, 5,000, 4,008. Sorry, 6,008. Yeah, because the first 6,000 is subject to CPF, which means you would need to pay 1,200 into CPF. Okay, and then after that, the rest is yours to take. Okay, so you can see that the drop in the disposable income is not too much, 6,008 to 6,004. Okay, but I think this is a good move because let's say you're in a job with not a lot of bonuses. Let's say you totally have no bonus and you're earning 8,000 a month. Okay, then actually the amount of salary that will be subject to CPF if before 2023 was actually just 6,000 times 12 or 72,000. So you will pay CPF contributions on 72,000 of your income. But if the ordinary wage ceiling has been increased to 8,000, now you'll pay CPF on 96,000 of your income instead of the previous 72,000. Okay, so this just means more CPF contributions, which, well, it'll help you to hit things like your basic healthcare sum faster, it'll help you to hit full retirement sum faster. And for people with, let's say you are in a job, or like I say, a contract job, or your job doesn't have a lot of bonuses or no bonuses, then it can actually boost your CPF pretty well. Okay, it's quite a fair bit of increase if you ask me. Okay, and then of course, if let's say the entire 96,000 of your ordinary wages, your monthly wages, it has already been subject to CPF, then this 102,000, that means that your bonus just needs to be $6,000. Okay, this $6,000 is subject to CPF for your bonus, and then the rest of your bonus will be in cash. Okay, so more cash for your bonus, I suppose. So that's how the ordinary wage and annual ceiling work. Okay, so we talk about contributions, okay, and how is it allocated among the three accounts? Okay, so there's this chart, it's from the CPF board website, but I've just put it out for your convenience. So basically, you can see that depending on the age band you are in, okay, your contributions would vary, okay, and of course, what happens here is that we can see a pattern that at the start, okay, when you are still, early in your career, okay, quite a fair bit of contributions is given to your ordinary account. This is to help you build up funds in preparation to get a house, okay? And then later on, this steps down. In fact, it steps down quite drastically. Once you are past 60, actually, the amount of contributions is actually down to like just 15% of your income, right? So of your contribution. So on the other hand, okay, you can see that Medisave contribution gradually steps up over time. Okay, in fact, you're above 70, the bulk of your money actually goes to Medisave. This is to help prepare for expected healthcare costs when you are older. Okay, and then of course in between, all the special account will creep up over time, but once you've gone past 70, actually, it's not a lot. Okay, so this is these changing numbers are supposed to reflect different priorities at different stages in life. More in your OA at the start when you're preparing to buy a house, more in your Medisave in old age to help fund your healthcare costs. And of course, special is going to ramp up until right before you retire. This to boost your retirement adequacy. Okay. So to find out how much you contribute to a CPF account each month, there is actually a CPF contribution calculator. Okay, so if you go online and go and Google for the CPF contribution calculator, you will be directed to this link. And then after that, you can go inside and play with it. Okay, we actually played with this in the first module where I shared the contribution calculator for Valerie and Vincent. Okay, so this calculator is actually that same thing I shared in the first module. You can use a calculator and key your wages that you expect to get. Your monthly wages will be your ordinary wages, and your bonuses, AWS, things like that, you can key under additional wages. You press compute and it will actually show you exactly how much contribution will be given to each of your accounts. Okay, so I think that is a more important thing, as well as how much total contributions you would get. Okay, so we won't be playing with the calculator. It's just something that if you have spare time, you can take a look at it. Okay. And of course, once you pay contributions into your CPF accounts, there's interest, and the amount of interest would depend on the account that you are contributing to. Okay, so it's just very important to know that savings in the ordinary account will earn the lowest amount of interest because it's quite flexible and can be used for a lot of things, for example, housing and investment. So the interest rate is more of a lower interest. Okay, so just understand that there is legislation. Okay, the minimum interest is 2.5%. So I don't think that's a bad thing. It's actually quite reasonable considering it's risk-free. Okay, but the thing to note is that the 3-month average of the major bank interest rate, okay, is actually very low. Okay, this 3-month average does not refer to those high yield saving account, multiplier account, or like UOB1 account where if you fulfill certain criteria, there is bonus interest. Okay, we're talking about purely opening, say, a current account, okay, with the bank and then looking at their interest rate, and that is usually very low, 0.05%. Okay, so this is why the minimum interest on CPF OA has been 2.5% for the longest time. Okay, so do not expect it to change. I do not expect it to change, frankly. So even if they're reviewing quarterly, I don't think anything will happen. The more interesting one is the special Medisave and retirement account, okay, whereby the interest that they will earn, okay, will be based on the 12-month average yield of 10-year Singapore government securities plus 1%. Okay, so due to the higher interest rate environment in the past few years, okay, it's been coming down now, but previous years, this 10-year SGSU has been 3 point something percent, 3.xx%. Okay, which means you add that 1% to it, your special medicine and retirement account will therefore pay 4.xx%. I believe at one point I was paying something like 4.08, so everyone was very happy and such, but I think it's come back down to 4% already because the yields are dropping. Okay, but the good news is that even during period of low interest rate, okay, the floor legislated is 4%. So that's a pretty reasonable interest considering it's risk-free. Okay, so just remember 2.5 and 4, but also remember that they are legislated. Okay, but this also gives the government room to adjust if they feel that they cannot keep it up. So whether they can keep it up, we can't say lah. So all I can say is just beware that there is they have every right to adjust this interest rate floor or change legislation. I don't think they will because it'd be a very unpopular decision, but it is well within their rights. Okay, so that's how you determine CPF interest rates. Okay, and of course, to boost retirement adequacy, there is something called extra interest. Okay, so basically on the first 60,000 of your combined CPF balance, there is extra interest. But if your bulk of your money is in OA, just note that the extra interest, they will only take the first 20,000 from your OA to earn that extra interest. And what happens is that the extra interest is paid into your special or MediSave account, depending on the balance lah, okay? And then after that, extra interest paid on your OA does not go to OA, so it cannot be like used to help you with your interest, your mortgage or what. The extra interest on the OA will go to your SA, okay, to enhance your savings. So that is the extra interest. What I would say is if government is going to give me more interest, I would just take it. It's free money lah, okay? Okay, now what happens if you're above 55? Okay, then the extra interest is the way it's calculated, what is given is slightly changed. Okay, so it'll be 2% extra, so up to 6% actually. Okay, so on the first 30,000 is a total of 6% interest. Okay, and on the next 30,000 is extra 1%, so 5% interest. Okay, and likewise, the interest earned on retirement and MediSave balance will go back to that same account, but the extra interest on the OA will go to RA. Okay, to enhance your retirement savings. All right, so that is where it will go. Okay, so how they compute? Again, extra interest, they start with your retirement account balance, then your OA balance, then your special and MediSave. Okay, so all this information actually on the CPF website, but just for reference, I think this is important for you to know. Okay, so that's how they compute it. Okay, so how else can you top up CPF if you, let's say, want to have more for whatever reason and beyond just your work contributions? So there are actually a few methods, okay, topping up wise, and then there's one last method which is called housing refund, but we'll talk about that later. The first one, CPF VC or voluntary contribution. The second one, retirement sum topping up, okay, or CPF ME topping up, okay, both of which would give you tax benefits, okay. And then the last one is OA to SA transfer. Okay, we'll take a look at these methods. Okay, so CPF voluntary contributions. Okay, CPF board has a very good rationale for doing a voluntary contribution. Okay, one thing is of course to grow your CPF savings, so that's great. Just take note that of course top ups are irreversible. It's one way only. So before you top up, always consider the fact that you might need the money. If you truly don't, then okay, but if you do, then topping up is an option lah. And of course, for the self-employed among us, including myself, topping up will confer tax relief, okay, based on our net trade income. Okay, so it's not necessarily a bad thing to top up for self-employed because first thing, tax relief, second thing, growing your contributions, because we typically self-employed would only be required to top up MediSave and nothing else. So yeah, but for those of you who are employed regular job, you may already max out your CPF contributions every year due from work, in which case this topping up may not be quite applicable to you because this refers to topping up of your 3 accounts. Okay, so yeah, point to note, you cannot exceed the annual limit. Okay, so which means if let's say your work income, your CPF from work income is already 37,740, expected to be 37,740, no point making the top up. Okay, and if you top up, in fact, I believe they refund you with out the interest. Okay, so you cannot cheat the system, top up, hope for interest, and then get it back with interest. No, they just refund you without interest. So to top up, there's a lot of methods. But most people, I think, just use PayNow lah. I can't remember if it's PayNow or PayLah, but you can just do a PayNow, scan a QR code, and top up to your 3 accounts. Take note, when you top up by this method, the amount you top up will be split among the 3 accounts as though it was a work contribution. So for example, you top up $4,000 into your CPF account via this method. The $4,000 will be split among MediSave, special, and ordinary account based on your age and other factors. For example, if you already hit full healthcare, the basic healthcare sum, then your top up money will go to special or ordinary lah. Okay, so just think note that you cannot direct where the money goes if you go top up via this method. Okay, so that's just something important I felt you need to highlight. Okay, you want to top up directly, targeted top up. Okay, so one method would be topping up to the retirement, the special account. Okay, this thing is called the retirement sum topping up scheme. Okay, so topping up by this method means you top up straight into your special account. Okay, and starting from, I think last year it was, you can also top up straight to your MediSave. These two methods, as long as you have not hit the ceiling, okay, of basic healthcare sum or full retirement sum, you will be able to enjoy some tax relief of up to 8,000 on yourself, on your loved ones, up to another 8,000. So total of 16,000. Okay. And of course, if you are a senior, okay, by definition of the government, you are a senior and you top up and you have not hit full retirement sum, the government gives you a bit of a contributing grant. Okay. So this can be helpful for, say, let's say, okay, so I'm topping up for my mom. She's a housewife, so she doesn't have a lot. So she top up, she can get a matching grant for the government, so there's more in her special retirement account. Okay. So topping up, if you want to top up by this method, it will go straight to the account you wish for, and there's a very helpful screen you will see. Okay, so if you want to top up, okay, you go into the CPF website, you go to the top up page. They actually will tell you how much tax relief you can enjoy and how much you have. Okay, so this is actually my own numbers. I just took this screenshot this evening. Okay, I already top up 4,000 to my special account. Okay, for tax relief. So I can top up another 4,000 to my special account and also be eligible for tax relief. Okay, but this is money that I'm willing to part with because I don't need it. I assess that I would not likely need this money for until 55. Okay, so everyone's situation is different. So please understand that you do this top up, it is irreversible. Okay, and at the same time, if you want to top up your loved ones, okay, then they also tell you how much you can top up. So it's important to note, okay, the relief is capped, okay, but the top up amount is not capped. Okay, so for example, if the full retirement sum is 200,000 and I have 100,000 in my special account, I can top up 8,000 and get relief. I can top up 10,000. I will also get relief, but my relief will only be up to 8,000. The remaining 2,000 will still go into special account and grow over time. Okay, but it's just that I only get the tax relief on the first 8,000. So it is possible if I wanted to top up another 100,000, make it total of 200,000, but then my relief is only 8,000 one time for next year. Same thing for loved ones. Okay, same thing for loved ones. And this one, okay, is, I know it says special and retirement, but you can actually also top up your loved ones' MediSave accounts and you will also be eligible for relief. Okay, so that's how the top up works. Okay, as for definition of loved ones, please refer to CPF website, but in general, it will be like your parents, your grandparents, your parents-in-laws, things like that. Yep. Okay. Okay, so this is the last method to topping up your CPF. Okay, OA to SA transfer, and this method you have to be careful. Okay, a lot of people have talked about this method. Okay, saying that, oh, you transfer OA to SA, okay, you reach your full retirement sum faster, you get more interest for retirement, things like that. Not wrong. Okay, because it is a fact, right? If your money is in OA instead of SA, you will get more interest. Okay, but there are certain drawbacks which I felt is not adequately talked about. Okay, and we'll talk about that. But the increased interest rate, okay, this part is true lah, because you have more money in your CPF SA instead of OA, right? Okay. And oh wait, I saw a question. Okay, So there's a question here. When you talk about parents, you still only get 8K. Yes, 8K is regardless of which parent you top up. If I top up 4K, my mom, 4K, my dad, that's 8K. That's what the relief I get. If I know that because I did that last year. If I top up 8K to my mom and 8K to my dad, 16K, right? I still only get 8K relief on my loved ones lah. So in the interest of balancing relief and ensuring money, there's enough money in my parents' account. I just decide to top up my dad and my mom both sides lah. Okay, so Singh, I hope that answer your question. Okay, maximum 8K regardless of who you top up. It's not 8K per parent. If not, you'll be open for a lot of abuse. That's what I can think of. Okay, so 8K in total. Okay. Okay, back to the this OA to SA transfer. So increase interest rate, that part is true. Okay, we're not going to dispute that. And of course, if you have more in SA, then your retirement payout in the future will definitely be higher. This part is also true. Okay. And this has led to a lot of people thinking that, oh, okay, I should just quickly transfer OA to SA. Okay. Not right, not wrong, but we need to consider the other scenarios, okay, which is if you top up OA to SA, then you definitely have less flexibility to use your OA for housing needs, okay? So you reach FRS faster at the expense of your OA account, which can be a problem because I think 2 years ago, I met this lady and we are just having a chat, okay? And she wanted to get term insurance to cover her mortgage, okay? Term insurance to cover her mortgage in case she's gone or, she falls sick, she needs money to pay the mortgage. And she was just sharing with me that she listened to a friend advice in her 20s. She did some OASA transfer gradually over the years, and then she reached her full retirement sum quite fast. I think before 35. But then when she turned 35 and she wanted to apply for a BTO as a single, she ran into a very big problem. There was not enough money. There was not enough money in terms of because you need cash for your reno and your appliances and all that. So she wanted to conserve her cash, but then her OA balance was really so low that when she wanted to buy her flat, she ran into a very big problem. So she had to defer her flat purchase until late 30s. I can't remember the exact age, but that was some time ago. So that's the thing. Even though we may read about people saying, oh, you transfer OA to SA, you can boost your SA savings and things like that. But it may or may not be the right thing to do depending on circumstances. Her friend who tell her to do this, actually, that friend of hers, I remember very clearly that friend of hers had support from the parents to buy a house. So even owing not enough money, the parents step in to help. But she does not have that kind of support. So when she want to buy a flat, owing simply not enough money to comfortably put down a down payment. So I always caution about this because just because you listen, you heard some financial so-called tips, right? It does not mean that it will always be necessarily applicable to your situation. So just take note of that. Second thing I feel is that OA to SA transfer, okay, if you hit your ceiling of FRS faster, then you cash top up, right? You will not be able to do it, which means you cannot enjoy the tax relief on that, okay? So this is something that they point out, and rightfully so. So that's why actually my whole life I've never done OA to SA transfer. I prefer to strike a balance and just ensure that I have enough OA for house. At the same time, I also have some room to enjoy tax relief via cash top up to SA. And of course, the last thing is that it's irreversible. Okay, you transfer OA to SA, obviously it's irreversible. You can't do anything. Okay, so that's one thing to note. And there's no tax relief like you do OA to SA transfer. Okay, some question. Well, questions only. Okay, hang on. Buck says regardless of parent income. Okay, Buck, I suppose you're referring to the fact that you're doing a top up to your parents or your loved ones. They must not be earning an income. Yeah, that part is true lah. There's criteria, right? So last time is your parents cannot earn more than 4K a year. They changed that to 8K a year. Okay, so if your parents are working, if your spouse is working, like yeah, this kind of cash top up will not earn tax relief. So the latest criteria, please refer to CPF board website, but I remember it's 8K. Okay. Joyce says, if top up your parent, do they get the matching government grant if they qualify? Okay, my understanding, Joyce, is that they should top up first, as in the top up must come from them to themselves. So what you can do, or what they can do, my mom in my mom's case, I give her 2,000, she top up in her name, and then after that's done, she's qualified for the grant. I'll come in and top up 8,000 for her. Okay, but that's my style of doing it, lah, Joyce. So I hope that clarifies. Richard says, now the SA is closed for above 55 and MA is max, where does interest go if we cannot go to OA? No. If your accounts are max, right, then the extra interest for MA will just go to your OA. Extra interest for RA will go to RA. Okay. Ingwa says, I know children can top up to same parents to receive 8K tax. Yeah, if you have two children topping up to one parent and the parent's not working, yeah, both children will get 8K lah. Okay, that's correct lah. Okay, but of course in my case, my parents are around, so I top up both to be fair. Jason says, what's the maximum amount to transfer OA to SA? You can transfer or top up to the FRS, okay? But OA to SA transfer does not have tax relief. Cash top up to SA, tax relief on the first 8,000 only. Okay, so hope that answer the questions. Okay, CPF, I have to admit, is a very complex topic because there's so many different schemes and the rules are changing all the time. So I always say that whatever I say today is as of now. Things can change on the road. So, most accurate information always on CPF website lah. Okay. Okay, and Jason asked, what is FRS? FRS is just the full retirement sum. We will talk about that later when we come to CPF Life. Okay. Okay, and the last method to put money back into CPF, okay, is something called housing refund. Okay, it's not really a topping up, but it's just paying back the money you use for your house. So this is my whole home ownership dashboard. You can see that I definitely need some money to put down the down payment on my HDB, right? So that was the amount I took out, including stamp duties and such. Okay, and as of this point, I have some accrued interest of $12,000. Now, when I sell, okay, not when, if I sell my HDB, okay, then from whatever proceeds I get, right, I must pay back 112.7K as well as the accrued interest. But if I, for whatever reason, if I sell the property that below and get a smaller amount than expected, okay, it does not mean that I fail to repay this amount, I'm in trouble. No, it's just something that I'm repaying to myself. It is still my money in a way. Okay, so just take note. If this amount is huge, okay, then you have a lot of ways to. There's a lot of room for you to put money back into CPF to earn 2.5 lah. Because home ownership suggests that the money is from OA, so you put it back to OA, you earn 2.5. Just take note. Interesting thing is, since CPF money is untouchable by creditors, okay, so this can be an interesting way for people to like lock money away from creditors lah. But we won't go there. Okay. Okay, so that is for housing refund. Okay, so it's just something that I felt worth mentioning about. Okay, so that's contribution. How about withdrawing? Okay, and what can you withdraw a CPF for? Okay, so you can withdraw CPF for many things. Okay, housing, education, medical purposes, investment, and retirement. Okay, we'll talk about housing, education, and medical. And then after that, we'll go for a short break and come back around 9 plus, okay, depending on the time. And then I'll cover investment and retirement. So housing, you can use CPF to service your loan. Okay, you can use it to buy property, put a down payment, or service your loan. Does not matter whether it's private or government or HDB. You can use your OA. Okay, but the one thing I want to highlight is that a lot of people may miss out on one thing, which is what I call falling OA allocation. Okay, so what do I mean by that? So you recall this chart, okay? The contribution to CPF OA is highest when you are below 35. Okay, so this helps you to build up the OA balance in order to put your down payment, for example. Okay, but after 35, your contribution drops a bit, then it drops a bit more, and then this bit it drops. I feel like this is quite a big drop lah. You can see that this is like 5% drop, right? But then there's a 10% drop here. So what this means is, okay, if you have contributions of the annual ceiling 37,740 every year, okay, and you're below 35, every year about 23,460 around there, yeah, will go to your OA. So if you are paying your mortgage via your OA, and let's say for simplicity, your mortgage is 2,000 a month, you will have a slight cash outlay of $45 a month. I think about $45 a month. Okay, for your mortgage repayment. So this carries on, and then when you turn, so assuming your OA balance is always zero, so you earn your your OA contribution come in, and then it's immediately used for your mortgage. Okay. At 35, your contribution drops. Okay. So that $45 a month cash that you pay, okay, now has to increase because you have lesser contributions to your OA. Okay. So instead of paying $45 a month cash for your mortgage, it will go up to about $200 a month cash. Okay. So this is what I mean by beware of falling away allocation. As lesser and lesser of your CPF contribution go to OA, you may pay out more and more cash for your mortgage. Okay, so 200 a month, and then at 45 to 50, this will actually rise to about 380 a month. And then if you're 50 to 55, okay, with only 40% of contribution going to OA, I won't talk about things like overflow from MA and all that lah. We just talk purely about ordinary account contribution. If at age of 50 to 55, you're still paying the 2K a month mortgage, okay, you will actually have to pay $700 in cash, okay, just to sustain that 2K a month mortgage. The remaining 1,003 will be from OA, okay. So from $45 a month in cash, you're going to $700 a month in cash over the span of 15 years, from 35 to 50, okay. So please be aware of that. Don't get caught off guard, okay, because if let's say your cash flow is tight, then suddenly having to pay a few $100s more in cash can be may set you back. Okay, so just take note. And of course, one thing I also say is that please keep, I would suggest keeping a buffer in OA in case of job loss, right? You have at least don't have to deplete your cash reserves to pay for your mortgage. Okay, so that is something I would highly suggest. And in fact, I always think that if you can keep that 20K, first 20K in your OA, you can also earn extra interest on that. So that's not necessarily a bad thing. So I would, if you can keep a bit more, depending on the size of your mortgage, but you can get a bit more, that's not necessarily a bad thing. But I think 20K is a nice amount because you definitely get the extra 1% interest. Okay. And at the same time, you got that buffer for your mortgage. Okay. Okay. So that's for housing. Okay. And then for education, okay, you can use CPOA to fund your own education. So yes, your own, okay. Your children, your spouse, your siblings, or relative. Relative also can, okay. But provided it's subsidized tuition fee, and there's a couple of criteria. Okay, it must be diploma or degree courses, and it must be at what we call approved educational institutions. The list is on CPF website. Okay, so please refer to that if you feel like you want to use your OA to fund your education costs. Okay, of course, and if you've given out a loan, okay, let's say you lend a loan to your kid, okay, if you are reach 55 and you already have FRS set aside, CPF board allows you to waive the loan, so that's a very nice gesture. You can just waive the loan for that you give your kid if you wish to. Okay, but we won't talk about the morality of that. Okay, so just take note, education. Okay, so it's quite straightforward. You can use it, and then after that you just need to pay back. Okay, the one I want to talk about before we go for the break is actually medical. Okay, so medical, this really refers to your MediSave account. What can you use MediSave account for in terms of withdrawal? You can use it to settle certain outpatient expenses. So my mom and dad have a lot of medical appointments. So every time we go to the hospital, in fact, we just went earlier this week. Okay. So after you see a doctor, the consultation, all that, right? Then usually the nurse will ask, you want to use MediSave? And we just say yes, right? Okay, so that's the good news. You can use MediSave to settle certain outpatient expenses, your doctor consult, your medication. Okay, but take note, if you're not warded, right, it's just a consult or what, typically you have to be above 60 before you can use your MediSave for these things. So yeah, I would know because I asked. So it's nice, okay. You don't have to pay a consult fee, but there are also limits and caps. Okay, so I remember one year when my mom had so many medical appointments that I think around September we asked, they asked, you want to use MediSave, and we were like, okay. And then they check and they say, oh, cannot. We've maxed out the withdrawal limit. We have to pay cash. Okay, but it's nice lah because ultimately, since MediSave money is probably the hardest to take out in a way, then you might as well use it for something, right? Okay, so that's take note. Okay, next thing, hospitalization, long-term care. So we're talking about actually MediShield Life as well as CareShield Life or ElderShield. These two schemes are pretty important. Okay, so you can use it to take care of the cost of this kind of national healthcare schemes and national caregiving schemes. Okay, so that's important. Okay, HPS and DPS. Okay, now I wouldn't quite outright classify that as medical, but you can see that if something happens to you, okay, home protection scheme will ensure that your loan gets paid off. Okay, DPS will give cash to your loved ones. Okay, we talked about that previously in module 2. Okay, but just take note, it's still an insurance of sorts. Okay, and the good news is you can pay from your ordinary account, okay, for HPS or DPS. But please note, okay, DPS, okay, if you have a shortfall or for either HP or DPS, you are allowed to use cash to top up the shortfall lah. So that's a good thing so that you don't lose the coverage. And lastly, Medisave money can be used for certain approved insurance premiums. Okay, so namely your integrated shield plan and your CareShield Life supplements, but there are also caps. Okay, so take note of the caps. Okay, this table should help you visual understand the caps. So MediShield Life. So on national scheme, MediShield Life, CareShield Life, the national schemes fully payable from Medisave. Okay, so you never have to pay a single cent of cash unless you've not enough Medisave lah. Okay, but for integrated shield plan, okay, you have caps. Okay, depending on your age, the cap is from 300 a year to 900 a year. The rest by cash. Okay, for shield plan riders, it's cash only, and for CareShield supplements, anything above 600 a year, you have to pay the remainder in cash. You are allowed to subsidize up to 600 a year for your CareShield supplement. Please take note, all these 5 things listed here are independent limits, okay? Because I often get this question, like people want to take a CareShield supplement. Some of them ask me, hey, but if I pay for my CareShield supplement, then my shield plan how? Not affected. Okay, the limit is separate. Please remember that the limits are all separate. Using your Medisave for CareShield does not impact how much Medisave you can use for your shield plan and so on and so forth. All right. Alice asked, medicine can only pay for specialists and inpatient, is it? Cannot pay for outpatient. Okay, for my mom and dad, it was outpatient. They just went to see doctor for consult, follow-up, and we paid via Medisave lah. So I would think there are rules, of course, on how much you can use. Certain outpatient treatment definitely can use Medisave to offset the cost. Okay, Joyce has a comment here, says, actually can use Medisave for some chronic diseases below 60. Okay, I'm healthy, so no chronic disease. Okay, yes, the chronic disease management program, I heard of that. We're not actually going to cover that today, but yes, there are limits per year. You can use Medisave for certain things, not everything. I suppose the government just wants to make sure you don't perpetually deplete your Medisave so that at least when you hit old age and you have no more contributions, there is a sizable balance in your Medisave to take care of any cost in old age. Yeah. Okay. And of course, cancer dialysis, actually that should be covered under MediShield Life because that's what MediShield Life would cover lah. Okay, which actually I'm covering next. Okay, but yes, touch wood that these kind of things don't happen to you. So we all rather be healthy, right? Okay. So MediShield Life, which is our national healthcare insurance, okay, is really very basic medical coverage, you ask me, okay? But the good news is even those with pre-existing conditions will be covered unless your pre-existing condition is very severe, in which case you will be subject to loading for your MediShield Life premium. I have not met anyone with this yet, okay? I suppose if you have loading on your MediShield Life, it's really quite serious, okay? So certain outpatient treatments are covered, as Joyce mentioned, and then there's cancer treatment, radiotherapy, kidney disease, things like that, okay? And of course, there are other costs that may be associated with your medical treatment, okay? Not everything is covered, okay? So you might have to rely on a shield plan for that. Okay, there's a comment from Inghua says MA can use for loved one. Yes, okay. Actually, you can use your MA if you're talking about using for your loved ones in the sense of premiums, definitely. My dad is actually paying my mom's CareShield supplement premium. So there are some flexibility in the use lah. Personally, I feel like there could be more flexibility allowed, but I'm not the Minister for Health and I don't make the policies. Okay. And if you ask me, actually, what I really wish is that the Medisave, okay, so going back to this slide, what I really wish is that for integrated shield plans, they allow a bit more in terms of how much Medisave you can use to pay the shield plan premium. Same thing for CareShield supplement. I really, really wish they would allow a little bit more. Doesn't have to be a lot more, can be just 50% more. So CareShield supplement, maybe you can use 900 a year. That's not really a lot in the grand scheme of things. And then for integrated shield plan, maybe 1,500, especially for the elderly, because even if you are in a government AWOD restructured shield plan, you will still pay a lot of cash for just your main plan alone. We don't even talk about the rider. Okay, so I do wish this could be allowed, but I'm not the minister. So yeah. Okay, but still it's good that we can use it. Okay. So I suppose better than nothing lah. Okay. Okay, so CareShield, we covered this in module 2, but just as a recap, CareShield or ElderShield, okay, or even the supplements, okay. The idea about these plans is that they actually, if you're truly disabled, okay, then you will get a cash payout, okay, and this cash payout, you use it to defray your caregiving costs, okay. Since it's cash, you can use it for whatever you need, okay. So for example, even buying like supplies, okay, like let's say you need adult diapers let's say your parent need adult diapers and they're severely disabled, the cash payout can be used for this, okay. But I always stress that the cash payout really isn't a lot, okay. Frankly, I really don't think 600 a month is a lot, even under CareShield Life, which is in itself already more than ElderShield. So the supplement plans are really, really very important in increasing the amount you get, okay, from a payout if something were to happen. At least $2,000, $3,000 more can help go a long way, even to offset nursing home costs, medication, supplies, diapers, things like that, okay. One thing that a lot of people may not know is you are actually allowed to have multiple supplement plans. So just as a sharing, okay, so for example, if let's say you have CareShield Life, okay, CareShield Life, and then CareShield pay 600, okay, and then you get supplement plan number 1, okay, SUP number 1, okay, at the age of 30, okay, and then let's say you paid 1,000 a year, okay, for the premium. Okay, sorry, this should be 600 a month payout. Okay, but we'll just cancel that. Okay, let me erase that. Okay, so CareShield Life, okay, you pay for MediSave, and then the supplement plan number 1, okay, your premium is 1,000 a year, okay, and then you got that at age 30, and then let's say at age 40, you're in a better position, you want a bit more coverage, you can get actually a second supplement plan. Okay, I do not know how many of you realize this, and maybe of course you're older at that point, maybe you pay another 1,000 a year, but let's say you evaluated your needs and you wanted more coverage in case of severe disability, then yeah, you are actually allowed to get a second supplement plan for yourself. The first one is not impacted, and in fact, you should keep the first one because you got that when you were younger, and therefore the premium is definitely cheaper. The supplement plan number 2, which maybe you got 10 years later, of course the premium is higher because you are a little older, but let's say you felt like, okay, you just wanted more coverage for whatever reason, and you wanted to get a second supplement plan, you have no need to cancel the first one. The reason I say that is because sometimes some of my clients, some of my clients, they get a supplement plan, and then they go on with their lives, and some years down the road, they go to a road show, people talk to them about supplement plan, and then they sign up without knowing that they already have a supplement plan. And then because their supplement plan, the second plan they signed up for, they paid, and then they deducted from MediSave, they use up the 600 cap for that year. Later on, when the premium is due for the first supplement plan, because the MediSave cap has been used up, okay, then when they try to deduct, they cannot deduct, and then they are asked to pay cash. But sometimes some people did not open letterbox, they move, they forgot update address, then they didn't pay. Supplement plan number 1 lapsed, which is really a pity because supplement plan number 1 will have been gotten when they're younger, and it's definitely, if it's the same premium, they'll definitely have more benefit for supplement plan number 1. So please note, that's why it's also important to at least have a good picture of what you have so that you do not accidentally override or let a plan lapse without knowing it. Okay, so I think this is just something I want to share because it has happened before. And then when my client realized that, they quickly reinstate by paying cash for supplement plan number 1 so that they have 2. Okay, so that they have 2. Okay. So Sheena asked up to 5 supplement plan or 5K. Okay, I'm not quite sure what your comment is, but I know that if you want to pay for supplement plan, you're allowed to split the premiums among, I've seen up to 5 people. Okay, Ingwa asks, each supplement plan can use up to 600 collectively. No, the 600 is a calendar year cap. Calendar year cap. Okay, so if your first plan already 1,000, then you've used up 600 for the year and $400 cash. Okay, 600 for MediSave for cash. If let's say you need a second supplement plan, let's say you wanted more, okay, which is not wrong if you think you would feel better with more coverage, then your second plan, you have to pay cash already lah. But usually CareShield supplements, ElderShield supplement, you ask me, it's not really a lot of cash outlay required, because I think what's more scary is if something really happened to you, then the nursing home cost per month is already far more than the premium per year of a supplement plan. Okay, so hope that answers your question. Okay, so next, we talk about CPF, withdrawing CPF for investments. Okay, so you can invest both OA and SA. Of course, there are certain restrictions that you need to take note of. Okay, so what are those restrictions then? First thing, you have to be 18. Okay, you cannot be an undischarged bankrupt, and you need to have more than 20,000 in your OA if you are looking to invest your OA, as well as if you're looking to invest your SA, you need to have more than 40,000 in your SA. Okay, and lastly, for new investors to CPF, you will need to complete this thing called the CPF self-awareness questionnaire. Okay, so this questionnaire has 20 questions and will test some basic knowledge about investing via CPF. Okay, so personally, I have assisted some clients to complete this. It's not really too hard. And I think you don't really need a full score uh, to invest your CPF monies. But of course, once you've passed the test, then just ensure that you download a copy of the test, like the cert lah, which will be provided. Then you can provide it if necessary. Okay. So, what can you invest your CPF monies in? Okay, so there's a whole list. Okay, I've reproduced it here. Okay, so first thing is of course unit trust. Okay, but take note, the number of unit trust that you can invest in is really not a lot. I think for OA there's probably like about 100, SA even fewer. Okay, and of these few unit trusts that you can invest with SA, I think none of them will really beat SA's 4%. So frankly, it's probably not worth it to invest your SA lah, you ask me, unless you tactically go in during a downturn. Okay. For OA, there's a lot more. 100 plus is actually, I would think, not too bad. Okay. There are some reasonable ones inside, but of course, compared to cash, it's a lot lesser lah. Okay. So unit trust, ILPs. Well, I don't recommend that lah. I think you're all aware of that. But you can. All these will be single premiums ILPs. There's no longer any regular premium ones. Okay. Annuities, endowment policies, but the thing is there aren't really any. It's allowed, but there are no viable, there are no options. Don't even talk about viable options. There are simply no options right now. Okay, same thing for endowment policies. HES, T-bills. T-bills popular, okay, but I think the most recent result is out already. Someone, I think it was 2.5%. I'm not sure, but it's come down to a point where it doesn't really make sense to invest your money, your OA money in. Actually, for a long time, you asked me since the start of this year, I probably would not have bothered investing my OA money into T-bills because of the management required and the fact that the incremental interest is really not significant enough unless you got like a million. Okay. ETFs, yes, there are some ETFs you can buy, okay, with your OA monies. Okay, fund management accounts, which basically means you are investing through something called investment administrator. We'll talk about that later. Okay, FDs, and then okay, stat bonds guaranteed by Singapore governments. Yes, there are such things, but right now, no product. Okay. Additionally, okay, you can buy shares, property funds, corporate bonds, but you can only use up to 35% of investable savings. Okay, this is a rule that they put in place so that you do not get wiped out, I suppose. Okay, and then Go ETFs and Go products 10%. Okay, so what's important to know is when you talk about this 35%, please let CPF calculate that for you. It's too risky to try and calculate yourself because you make a mistake. Okay, then when you try and buy and you buy more than you actually have, then the order will either get rejected or become a cash only order, and then you will be asked to pay cash, which might be a lot. Okay. So how do you know how much you can invest? Okay, in every time you log into CPF board, there are a lot of dashboards. Go to something we call the investment dashboard. You will see this. Okay, they'll tell you how much you can use for professionally managed products, how much for stocks, how much for gold, and then for SA, if you want to use it, then how much you can use. Very importantly, okay, when you buy stocks, 51,730 in this in this example, okay, this needs to include your cost of buying the stock, which means your brokerage, your GST, your exchange traded fee, all that you need to include it. Okay, don't buy $51,730 of stock exactly and then no money to pay brokerage. The whole order will become a cash order. Then you will be on the hook for that. Okay. Nicholas asks, how long do you take to calculate investable savings? Actually, that's a good question. I really do not know, but I should suppose if you see as of 10th, it should be quite accurate lah. Okay, but take note lah, you're buying over a few days, then please bear in mind that settlement does not occur immediately. Okay, so you might want to jot down like the total cost of your buy purchase, including the transaction cost, and then subtract accordingly lah. Okay, so I would think if you see this, that should be accurate. But you're going to buy a few times over the next few days, right? It might not update as fast. So I suppose they are logging tomorrow. This will update to 11 April. But remember, yeah, buy a stock today, settlement is not today, it is later. Okay, so that can impact what the dashboard shows you. So just take note of that. All right. Okay, so yeah, always refer to this dashboard when you want to invest, especially for stocks. It is we've seen people who buy and then thought it was just nice, but in the end up become must pay cash. Okay, so just as a note of that lah. Okay, and if you have invested your money, okay, then of course they'll tell you like how much available, and of course there's a summary lah. So you see a negative actually means you make money lah. Okay, because if I remember correctly, you put back more than you take out. Okay, so that's why the amount is negative. Okay, so very importantly, you notice this thing called agent bank for CPF OA. So what does it mean is if you want to invest your OA money, you need to open something called a CPF investment account with an agent bank. And the agent bank refers to any of our 3 local banks. You have to open with them, no other banks. I suppose we can support local. Okay, so you want to invest SA, that's a separate thing. You don't need an agent bank. You don't need an investment account for SA. This is only for OA. Okay, and then after that, you must have a investment platform or account to transact. Okay, opening the investment account with the agent bank does not mean you can transact immediately. You need some kind of account that will allow you to transact. And therefore, when you transact, there will be charges. Okay, so what kind of charges? This is just put from the local banks. Okay, just know that there are charges. For example, you buy shares. Okay, it depends on how many shares you buy. The quantity of shares. So you buy 1,000 DBS. Okay, that's the transaction cost from the agent bank. Does not count brokerage. Okay, but you buy 1,000 shares of Singtel, which on a per share basis is 10 times lesser than DBS. You still pay that same 273. So take note of that. Okay, so there are costs for basically anything. If not, how the bank make money, right? Okay, so of particular importance is something called investment administrator. Okay, whereby I'll touch on it in detail later, but this is an important way in which you can kind of reduce your cost of transaction. Okay, so the same thing goes for OCBC. Charges are all there. Okay, and UOB. Interestingly, UOB is a little cheaper when it comes to shares because it's $2 per 1,000 shares. Okay, subject to a maximum. Okay, the rest were actually 250, and all these are all subject to GST. UOB is also interesting in the sense that they allow you. This is where you can get buy gold. Okay, buy gold. So about the investment administrator thing, okay, why is it important? It's because when you transact, you will pay a cost for every transaction, and it goes up with the number of transactions you make. Okay, whereas we are investment administrator, the strength of that is that an investment administrator will actually collate all your investments. So for example, if I buy 10,000 shares of company A, 10,000 shares of company B, okay, what happens is that the investment administrator will collate and say that, okay, I need to draw 20,000 from this person's CPF. So it'll go through the agent bank, through the investment account, and then request a $20,000 of funding. Okay, and the local bank, the agent bank, will just see this as one transaction, even though on your end you probably paid 2 brokerage or whatever it is, but it is the transaction is amalgamated, is collectively combined at investment administrator side. So if I were to buy 3 different companies, $10,000 each of shares or even unit trust, okay, it's only one transaction from the eyes of the agent bank, because the investment administrator will just tell the agent bank, I need 30,000. Okay, he will not tell. You won't say anything more on that. So you will be charged based on transaction. Whereas you buy directly with the bank, okay, with the local bank, then each transaction you go pay brokerage plus a transaction fee to withdraw the money from your CPF. So that is the key thing about investment administrator. As the name suggests, An administrator helps you to collate and administer your transactions in a cost-effective manner. So really, there should be no reason for anyone to invest with the bank. Just open an account with an investment administrator and transact through there. That will be a lot better. So in Singapore, we got 4 investment administrators, Fidelity Securities, we are one, okay, Navigator, iFAST, and UOB Kay Hian. So these are this is probably where you want to open your account with lah. Okay, so that's for investing. Okay, as for what to invest, which unit trust, which stock, all that, we'll talk about that in the later modules when we explore part 2. Okay, when we cover unit trust, stocks, and stuff like that. Okay, so just take note. Okay, and now the big one. Okay, so CPF Life. When we retire, okay, we are going to need income. That's the purpose of CPF, and hence, CPF Life exists, right, for the sole purpose of giving you income when you retire. Okay, so what happens at 55? Okay, when you turn 55, a retirement account is created. Okay, and then they will transfer money from a special account to the retirement account. Okay, SA to RA. And how much they will transfer, the amount is known as the full retirement sum, unless you've pledged your property, but we won't talk about that. In general, if you don't pledge your property, you just let things happen naturally, then the amount that is transferred from your SA to your RA will be the full retirement sum. And this amount this year is 213,000. Now, please take note, this is not like a passing mark. Well, you don't have to hit 213. If you only have 150,000 in your SA, and you know your OA has other money. So let's say we just talk about SA, you only have 250,000 in your SA, then that's what they will take. And it doesn't mean that you broke any law or anything. Okay, you do not, it's not a must to hit FRS, but of course it's good for your own retirement sake. But if you don't have enough, it does not mean that you're in trouble or anything. It just means you have lesser. Okay, so after that happens, the remaining, if let's say you manage to hit full retirement sum, the remaining money will be transferred to OA, and then as of this year, your SA account will be closed. Okay, so this money in your retirement account, okay, will grow with interest, and after that, at 65, it will be placed into the CPF Life scheme. If you don't do anything, standard plan, and then from that CPF Life, you will receive payout for life. Okay, as long as you live. Okay, so this is what I mentioned. Okay, now important thing to note, okay, you're always allowed to withdraw at least 5,000 from your OA account at the age of 55. Okay. Okay, so if we have to put it as an illustration, okay, so what happens if your balances are like that? So you can see here that the day you turn 55, you will see no more SA account, it'll be closed, and then you will suddenly see this account called RA with 200,000 inside. Okay, I'm assuming that the full retirement sum is 200,000. Okay, and then your OA was suddenly at 400,000 because they took the remaining 100,000 from your SA and move it to your OA and then close your account. Okay, so this is on the assumption that FRS full retirement sum is 200,000. Okay, always take note, basic retirement sum will be half of FRS, and as of this year, enhanced retirement sum will always be twice of FRS. Okay, so what if you wanted more in your retirement account for whatever reason? Okay, then you choose to go for what we call enhanced retirement sum. You must then give instruction to CPF board to move 200,000 from your OA to your RA. Okay, and then this is what happens to your account balances. So take note, enhanced retirement sum is not compulsory. The default is full, and they leave it to you to decide whether you want to go to enhance or not. Okay, and then that's it. No more SA. Okay, only RA, OA, and MA. But of course, MA we won't talk about it. It's does not really contribute to your retirement in a way. Okay, so what happens to the money in RA? It will continue to grow at 4%. So let's take the scenario of someone with just full retirement sum, 213,000. Okay. Yeah, okay. Maybe just ignore the year. This should be 2025. But at any rate, your retirement account balance will grow. I have ignored the effect of extra interest because it's actually quite difficult to compute. It all depends on the months and things like that. But assuming a full year of let's say this person turned 55 in January, then your retirement account balance continues to grow by 4% every year. And of course, if you pass away prematurely before receiving the retirement account, the CPF Life payout, then your family will get what we call the bequest, or some people call it death benefit, okay, of your retirement account balance, as well as any other money you have in CPF, subject to the way you nominated it. Okay, so depending on what they receive, you pass away prematurely, okay, the rate of return is always 4% because that's the interest you're getting every year on your retirement account balance. Now things get interesting at 65. whereby they take your retirement account balance, and if you are going for the CPF Life standard plan, they take this whole money and put it into CPF Life, and from then you get a payout. Now, the payout is estimated currently to be about 20,000 a year, or about close to 1,008 a month if you take standard plan. Okay, and it's important to note that if you are receiving payout, okay, and then you pass on, okay, then what is given to your family is basically what you put in CPF Life, 315,000, minus away the payout you would have received. Okay, so you pass away at 74, they take 315,000, minus away the payout you have received up to that point of 207,000. The remainder 107,000 is given to your family. This is called bequest or death benefit. But because this is how it's calculated, that means as long as your CPF Life premium of 315,000 is not yet fully paid out to you in the form of your payouts, then the total received will always be 315,000, which means the rate of return actually drop because you're getting, you plus your family is always getting the same 315,000, but you get it over a long period of time. Of course, the returns are dropping. Now, the return will drop to a certain point, which is around age 80, whereby after that, okay, you continue to get the payout because that's the whole point of CPF Life, to give you a payout for life. But since you used up the entire 315,000 you put into CPF Life as premium, okay, so the amount you actually get, in a way, it starts to, it continues to increase, and the total received in terms of the payout plus any remaining benefit, which actually will be zero from this point onwards, this total will also increase. So because it's increasing, then your rate of return actually improves. So this is to address a very important thing. The interest on CPF retirement account is 4%. The return of CPF Life depends on when you pass away. Let me repeat that. The interest on your CPF account, RA, is definitely 4%. That part is always true. But the return you get from CPF Life depends on when you pass away. It can drop to 2+%, but the longer you live, the return is of course better. If you live to 100, then your return will actually be, I think like 5%, something like that. Okay, so because we don't know how long we're going to live, it's actually also very difficult to estimate what kind of return you will get from CPF Life. All right, so this is what I want to set forth as set straight, okay, and is something that's very often talked about because CPF even have this thing on their website, this page, right, where they say, you know, how much CPF premium balance will my beneficiary receive when I pass away? Okay, because there's a lot of, I don't know why, but there's some people say that, oh, I will get back lesser than what I put in if I die early. Okay, you're talking about what you see. Of course, you die early, you only receive, you only have seen whatever payout you receive, but your family members will get the rest of the money. So as a collective unit, your entire family will actually get, at the very minimum, your CPF Life premium. Okay, so this is from CPF board website. So you see, after you pass away, beneficiary receive CPF Life premium balance. And what is this balance? The balance is basically what you pay to CPF Life minus what you receive. Okay, and then of course with anything else in your OA or MA okay. So this example here makes it very clear. If your CPF Life premium is 200,000, you pay this premium standard plan, then you start getting 1,000 a month, for example, and then after 10 months you pass away. Okay, then your beneficiary get 190,000. Added to the 10,000 you have gotten, that in total is 200,000. So you will never get lesser than what you put in. It's just that it's not you seeing the money, it is your family members. Okay, but if you put in and then next day you die, then of course the remaining 200,000 just go to your beneficiaries. Okay, so that's how it works. Okay, I see some questions. Sheena asks, sorry, back to investment account. To buy through administrator, will still need to set account with local bank. So Sheena, yes, you're talking about OA investment, you must have the OA, the CPF investment account with the local bank. Then you open a platform with the investment administrator, link your OA investment account, and then you can invest from there. Okay. Okay, some of you are sending me direct messages. It'd be better for like the group if you send it as a public message, because your question may be other people's question as well. Okay. But anyway, let me just read out. Someone asked, what is the difference between CPF Life Basic Extended Plan? We'll get to that. Again, another question is, hey, what is HDB pledge under CPF Life? How will it affect my payout if I sold my HDB? Okay, so HDB pledge is something that I think is actually double-edged sword. You pledge your HDB just means that you don't have to put as much into your retirement account. You only need half the amount. But the problem is, if you sell your flat, you have to repay and repay back to the full retirement sum. So unless you're absolutely sure you're not selling your flat, and I would say a lot of times we simply don't know what the future will be like, okay, then you may actually, I wouldn't think it's very wise to pledge your property, but that's just me. That's my take. There's pros and cons. You want more liquidity, you pledge, then of course you have more money to take out, right? But things can happen because, for example, my aunt, okay, just sharing an example, my aunt always stay in Clementi and we always thought that she'll just retire there. But she, at the age of 64, she suddenly decided to apply for Tengah BTO. So yeah, you never know what will happen. Okay, Ray asked, you want to leave behind that benefit? Does it mean basic plan is a better option? We'll talk about that in a bit, but the nutshell is yes, unless you live very long. Okay, unless you live very long. Okay, so let's talk about some more common misconceptions. My CPF Life premium do not earn interest. Okay. Again, CPF Board got an entire article about this, but the gist of it is that the premium you pay earns interest. The question is, where does the interest go? Okay. So what happens is, okay, the interest earned goes to what we call common pool. And the common pool purpose is to pay payouts to people who live extra long lives, longer than the average. Okay, that's the whole point of risk pooling. That's the whole point of an annuity. Okay, so CPF Board wants to ensure that you know that it is not entirely lost. So actually, you tell me they say not entirely lost means part of it is lost, but at least not entirely. Okay, so they comfort you by saying that depending on your longevity, so you live very long, you may ultimately receive more than the interest you contribute, which means you live very long, not only you get back your CPF Life premium paid, you get back the interest that was supposed to be paid to you in the form of payout, and then now you're taking other people's interest. So it is your interest to live longer, if you know what I mean. But again, we simply have no control over that, right? So I can see why some people would rather not want to cross-subsidize other people too much in case they live a short life, right? Okay, but you live very long, definitely you're taking payout from CPF Life. That payout, right, would have included other people's interest, those people who pass away early. Okay, so long story short, you do not lose interest, but you lose some of it because it's not entirely lost. Okay. And then yeah, so they come out to dispel this myth. They say that your CPF Life premium will continue to earn interest. We will continue to earn interest. So don't worry, it's just who gets the interest okay. And the second misconception, they also want to, so you see, the CPF Life premium will be distributed to other CPF members after death. Okay, this one I already mentioned earlier, the premium is not distributed to other people when you pass on. It is given back to your beneficiaries. Okay, minus net of whatever you already received. But the thing is, the interest that you would have earned on your CPF Life premium will not go back to you. Assuming that you have not fully depleted a CPF Life premium, the interest earned has already gone to the pool, okay? And it goes towards providing payout to the surviving members. So you want to maximize CPF Life, live long, okay? So that's the general idea. So is CPF Life still good? And my answer is, yeah, not bad, not too bad. Why? Because it offers a pretty good payout for what you put, okay? We have to acknowledge that CPF Life as a national scheme, it pays relatively well per dollar you put in. And the important thing is, if you happen to live very long, it will never stop paying you. So I think that's a good thing because we don't know how long we live. Okay. And good or not good, this one to me actually is very, I would think it's not so good, but some people think it's a benefit. If you are still working, you can defer the payout. Okay, you can defer the payout. The drawback is that there's not a lot of flexibility. Okay. The options are not too many. Okay. And then once you start, right, that's it. You start, then there's no way to withdraw no other way to withdraw money. It only starts at 65 earliest. So those of you who want to retire early, then what are you supposed to do, right? Okay. Some people don't like the fact that the interest, it goes to the pool, but that's just how it works. And I think the biggest risk you ask me about CPF Life is that policy changes. Today, CPF Life starts at 65. What if down the road they change to 67? Okay. So that is a problem. Okay. Question. Refer to your aunt case. After she get a tengah, can she pay a tengah and reduce the RA to BRS? Okay. Actually, my aunt is already 65 lah, so she won't be pledging. But whether you can pledge the tengah HDB, I don't think you can. If you already have FRS, they will not. I don't think they will allow you to pledge and then withdraw the money. But you might want to write into CPF board to clarify that. All right. And Sheena says deferred payout earn 7% interest. Okay, no, Sheena, it's the payout will increase by 7%. The interest is not 7%. So we just need to be specific about it. It's not the interest is 7%, it's the payout increased by up to 7%. I will talk about that in a bit. Okay, in fact, it's the next slide. So you defer, okay, the payout will increase by up to 7%. Okay, and I have been told that this 7% is actually linear. It's not compounding, it's just basics. It increased by 7% in terms of simple compounding, not compound interest. What this means is if your payout is, let's say, 20,000 a year, okay, if you defer every year, increase by 7% or 1,004 every year. Simple compounding, not compound interest. So maximum you could possibly get is $27,000 at 65. Okay, so this table has been updated to reflect this, which also means if you decide to defer your payout, okay, what can you expect? So it's important to note that even though you have more payout later on, if you choose to defer, the total you actually get, right, will be lesser than if you start the payout earlier. For the simple reason that you have to play catch up. All these years, you receive nothing. Okay, whereas the person who started the payout straight away is already $100,000 ahead of you. Okay, will you catch up? The answer is yes, but it's not that fast actually. So you can see that there is just differing even 1 year by age of 75. You're still like lagging behind lah. Okay, you're still lagging behind. So when does the catch up occur? So just some statistics for reference is that only at age 80, then maybe the person who defer by 1 year actually receive a bit more, $1,000 more only, which wouldn't really be a lot. Okay, at age 85, cumulatively, the person who defer payout by 3 years will receive the most lah. But you ask me, right? It's also not a lot more. It's only $15,000 more. It's not even 1 year of payout more. Okay, and of course, by age 90, the person who deferred payout until age 70 will receive the most, but that is only $47,000 more. Okay, which is like maybe 2 years of payout more. Okay, and you're living to 90, I would say congratulations because your longevity is there, right? So personally, my take is I would not defer. I will actually just take my money and go and spend it because it is my money, and why would you not want to retire and spend, your money, right? Okay, question from Nicholas says, does it make sense to defer? You have SRS payout starting for 62. Will the whole equation change? You ask me SRS, even your SRS starting at 62, I still wouldn't defer because I die early. I would still want to have received my money to enjoy it, right? So it's just more money for me. So even my SRS payout starts from 62 to 71. Okay, yeah, I can receive more when I turn 65 from CPF Life. I will just want to take it and then go and spend it on whatever I want to do because, well, that age of 65 is probably when at the age of 65 to the age of 75, right? Our best health is definitely at 65. We cannot be healthier at 75. So at 65, if you're healthy, you want to do things in your retirement, you must have the money to support it. And so if at 69 something happened to you, but you defer your payout to 70, that $27,000 coming at age 70, you also cannot spend it already because something happened to you. For example, touch wood, say stroke or something, right? So you ask me personally, I can see the benefit of deferring in a way that you do get more, but I would very much rather just have my money to spend. And even if I have SRS in the equation, having more money to spend is never a bad thing. Worst case, right? If I take this payout, I don't know what to do. I can just do a housing refund, put it back in. At least it's still earn 2.5 until I need it. Because by this age, I can freely withdraw money from CPF. So no harm to take the money out earlier, if you ask me. Okay. But that's just my take lah. Okay. If you want to defer, as I say, nothing wrong. Okay. Okay. So that's cumulative payout. Now, about the question that was asked earlier, what's the difference between standard, basic, standard, escalating? We'll talk about that, and then we will wrap up for the day. Okay, so we've got 3 CPF Life plans. Okay, escalating, standard, basic. Okay, so as the name suggests, escalating plan pays escalating payouts. Standard plan is a steady payout, and basic plan pays you reasonably for a while, and after your CPF balance drop below 60,000, it will reduce. Okay, but the reduction occurs roughly around age of 90. So that's actually quite a lot of years later. Okay, so how do the plans work? Okay, and this one is important to know, especially for those of you who want to maximize not losing your CPF life premium interest. Okay, so the basic plan, basically, you only pay 10 to 20% of your retirement account balance into your CPF life premium. The remaining 80 to 90% remains in your CPF life RA, and from there they provide payout, which means the interest earned on this 80 to 90% that sits in your RA is yours lah, because it's not gone to CPF life ma. The only interest that gone to CPF life would be whatever this 10 to 20% is paid into CPF life. Then of course the interest on that CPF life premium will go to the common pool. Okay, your money is in RA, the interest on the RA is yours and yours alone. It will be then used to provide the payout. Okay, but as your CPF retirement account balance drops, okay, then they will reach a point where your combined balances will drop below 60,000, at which point the extra interest also drop and your monthly payout slowly decreases. And then when your RA is completely gone, $0, then that's where the common pool, CPF life premium, the common pool will be used to support your payouts, but at a lower level. Okay, standard plan, all your retirement account savings will be deducted as the premium, and then you get your payout from CPF life. So this means the entire amount, the 4% you would have earned interest on, since it's paid into CPF life premium, that 4% goes to the pool. Okay, so, and of course, the premium you pay, they deduct the CPF payout from there first. Only when you have fully depleted it, then you get it from the common pool. Okay, the interest from the common pool. Likewise, escalating plan, same thing. The entire RA balance is deducted as CPF life premium. So I think these are the key things that we should take note of. Okay, and of course, being an escalating plan, then the payout start lower and increase bit by bit every year. Okay, so that's how it is. Okay, the increase is about 2%. A modest increase. So you live very long, then you will probably benefit a lot. But I believe you have to live to like 95 before escalating plan will definitively pay you more than the standard plan. Okay, 90 to 95. Okay, so that is how the escalating plan works. Okay, couple more things I need to point out. CPF life payout is not guaranteed. Said this many times before, but just remember it's not guaranteed, which means even when the payout start, okay, CPF board have the right to make any adjustments that they deem fit, maybe due to longevity issues or what, people are living longer, then they might have to tweak the payout downwards. Just know that if they were to make any of these changes, then the changes would be gradual and very small. Okay, it will be gradual and very, very small. Okay, but they cannot guarantee the payout, because if they did, then the payout will be a lot lower for what premium you pay in. Okay, or they will require a higher CPF life premium in order to sustain that guaranteed payout. Okay, we got a question on what's the difference between life, basic, and standard. Actually, I got a summary table that's about to answer all of that lah. Okay, so if we were to summarize the options, basic, standard, escalating. Okay, first thing first, the payout. Okay, first thing first, the premium you pay. Okay, the basic plan, you take 10 to 20% of your retirement account balance, and that will be the premium you pay into CPF life. For standard and escalating, you take your entire RA balance and pay. Okay, second thing, the payout for basic, standard, escalating, the payout for standard will be the highest at the start. Basic will lag behind by maybe $100-200 a month. Okay, so the standard payout will always be the highest. Basic will always be a few $100, $100-200 lower. So I hope that answers your question, Kailas. Escalating will likely be the lowest, but because it's escalating, it will go out at 2% a year. Eventually, it will take basic. Eventually, it will take standard. Okay. Okay. Next thing, the bequest. The payout. Where does it come from? The basic plan pays you from your own RA until the age of about 90, and after 90, it will pay from the common pool interest. Standard escalating will always pay you from the CPF life premium that you have paid, and after you deplete that, they'll pay from the common pool. So you see where this is going. If you pay lesser CPF life premium, then the interest on your RA balance is, well, yours lah, as I mentioned. Okay, if you pass on, okay, the bequest will basically for basic plan will be your RA balance, okay, because you haven't depleted it. But if standard escalating, because you have fully depleted your RA money, it's gone into CPF Life, then if there's any unpaid CPF Life premium, that will be the bequest you pass on. Okay, and some other notes lah. Payout is lower, and you know the payouts will drop as well as if your balances drop. Okay, see some questions. So Ray says that, so can one say that it seems like basic plan has a good chance to be able to leave some death benefits rather than the other two plans? Yeah, actually, you ask me because CPF Life payout for it comes if you take the basic plan, it comes from your RA. So as long as your RA got money, that is in a way the death benefit to your beneficiaries. That's that it dropped, you know, over time. And the thing to note is that we don't know how long we'll live. So since the bequest is from RA balance, okay, and RA balance will drop slowly because you still get 4% interest to support that, to prop up the balance, then likely you will have a good chance. Because anyway, last time CPF board, there was a calculator on the website where you can see the payout and the bequest, but they remove it lah. What I remember is that the bequest from CPF Life basic plan lasts the longest. I think it will there is some bequest all the way at least until age 85. Okay, around age 85. But for escalating and standard plan, the bequest is all gone by age of 80. Okay, so just take note of that. I hope that answers your question, Ray. Okay. Buck asks, why variation of 10 to 20% for the basic plan premium? Okay, this one we do not know. They are, I think you want to, okay, I suppose the amount you have to ask CPF board, okay, but I guess CPF board just didn't want to commit a number lah. Maybe it's due to longevity issues or actuarial numbers, I do not know, but I guess the best they can do is just give you an estimate. It will be about 10 to 20%. You want to be cautious, you can say 20% lah, then left 80% in your RA lah. Okay. Vera asked, will see IL earn interest in basic plan? Yeah. As long as the money in your RA, you will earn interest. Okay. It's just that the payout comes from your RA as well. So since the payout is typically more than the interest, your RA balance will drop over time until it goes to zero. That's for the basic plan. Okay. Sheena asked, basic is about 1 to 200 lower compared to standard. Actually, it depends on whether you have full retirement, enhanced retirement, or basic retirement sum lah. But definitely basic plan, if let's say you are on standard, you're on full retirement sum, and you're talking about difference between basic and standard, it's about $100 to $200. So some people feel like, well, I'm then only getting $100 to $200 lesser. If that means I have a good chance to leave behind money, I pass on earlier, then I don't mind taking a little lesser. So everyone has their own thoughts about that lah. Okay, but that's basic is definitely lower than standard. Okay. There's a question. How much will they pay one under basic at 90 and when RI is used up? For okay. When RI is used up under basic plan, okay, then the payout from the payout will continue from CPF Life premium under the common pool. Okay. So that amount will be lesser than what you have gotten from CPF Life basic plan. Okay. But how much lesser, it again depends on your RA balance when you started CPF Life, because everyone has different RA balance. Some may be not quite full retirement sum, some may be enhanced retirement sum balance. So it all depends. Okay. But it's just that when basic plan, you deplete your RA already, the payout comes from CPF Life common pool. That payout is definitely lesser than what you get from the original basic plans. Okay. Okay, Joyce says, really depends you want what you need CPF to provide, but right, it should be our retirement. I agree. It's my contributions for my retirement. That's my take lah. Okay. No need to think of because here you're educated there and provided a good start of life. True. Okay. So if you have provided in other ways, why not? It's just that sometimes, some people may not be may not like the idea of the fact that if they take the standard plan, then the interest on the entire CPF life premium, which is their whole RA, goes to common pool. Some people just do not like the idea, and I can also see why from their perspective. So there is no right or wrong. This one becomes a personal choice. Yeah, but I got one client with 500,000+ in RA. He is not keen at all to actually do standard plan because he'd rather have the interest paid to himself. So he's deciding to go with basic, not standard. Okay. So yeah, everyone has their own view on this. Lee Ting asks, you pledge your house to meet FRS, does that mean you have to top FRS when you sell a house? Yes, you do. You do. Okay, so that hope that answer the question. Okay, so which plan is the best? Basic, standard, escalating. I think we had quite the debate on that. Okay, so I'll just recap some of the things. Some people have considered the interest pooling. Okay, this is the reply from CPF board to my client, the one with 500,000 in his RA right now. Okay, when you pass away while receiving your payout for RA, so this is definitely about the basic plan, right? Because only in the basic plan you get your payout for RA. Okay, the beneficiary receive the full CPLI premium you paid and remaining saving your RA, OA, and MediSave. So because, again, I recap, if the CPLI premium paid, if you choose basic plan, the premium you pay is a lot lesser, 10 to 20% of your RA only. So the interest that is so-called you lose from this premium you pay that goes to common pool will therefore be a lot lesser. Okay, so just take note of that. I think this is probably one of the biggest debates. I don't think they will ever find a solution for this, because the whole point of risk pooling is this is just how risk pooling works in actual science. But I feel like, as who was that, as Joyce says, like, it really depends on what you are looking for. Okay, some people are perfectly cool with the standard plan because they expect to live happy retirements, healthy retirements, and therefore they do think they'll live long enough to see money from the pool interest. Okay, so there's no right or wrong. So in conclusion, CPF really, if you ask me to wrap up, because yeah, it's getting late. Okay, CPF does provide a lot of basic needs in retirement. Okay, it allows you to have money to get a house. It covers the basic cost of healthcare, but of course we all know that's not quite enough. But it does provide some coverage in terms of the healthcare costs, healthcare premiums on the national schemes. Okay, but the thing I see about CPF Life is that really there are changes that we have no control about. When Lawrence Wong announced the closure of SA last year, well, no one had any say in that, right? But we just had to learn and adapt based on that. Okay, but it's only not within our control. Okay, what we can control, I'll talk about it later. But and the thing about CPF is that flexibility is somewhat limited. I won't say there's no flexibility. Okay, you want more options available, then, like, say for retirement, then CPF may not quite suit you. Okay, and you want, for example, a better healthcare, then of course MediShield Life is not adequate lah, or CareShield Life will not provide the payout you're looking for if you are disabled lah. Okay, and of course you want to retire early, CPF Life can't do much because it just starts at 65, and the amount you get, really, if you ask me, given the cost of living now, is for a basic standard of living. Okay, you're not starvation level, but it's definitely not enough for you to do, like, go for holidays frequently and such. You won't starve on CPF Life basic, CPF Life FRS standard plan. I don't think you will starve. There should be enough for you. But you want more, then you got to look beyond that lah. Okay. Okay. So CPF Life projections can change in terms of the payout. It can be adjusted, as I mentioned. Okay. And options 65 onwards, that's it. Until 70 you can defer, but basic, standard, escalating, that's about all. Not too many. So I always say that CPF Life, CPF and CPF Life, I don't think it's a bad thing. It's just that the policy risk does make you want to feel like you must have a backup plan in case something happens that might set back your retirement, for example, right? So I know that many years ago, when I was a kid, probably, government allow you to take out CPF at 55, then people start to spend, and then by 65 they run out of money completely. Okay, so then government introduced retirement account, what do you call that? Retirement sum scheme, and then later on CPF Life. This is to, sometimes you put too much flexibility in the hands of the common person, then they might not use it in the best way lah. Okay, that's what I can say. Okay, so if you ask me how's the best way to maximize CPF in general, not just CPF and all the schemes, right? Just ensure steady contribution. Contribute. That's what we can all do anyway. All right, whether you're self-employed, whether you're employed, contribute, and then let's let time work its magic. Because if you have consistent contributions, you should not have to worry about meeting the basic healthcare sum, which I realized I forgot to talk about, but it's about 75,000 this year, 75,500. You should be easily hitting at least full retirement sum, and then of course the remaining amount in your OA, you can use that to get property to have somewhere to stay when you're old. So since CPF also has a cap of 37,740, that's the maximum you can contribute anyway. Just steadily contribute no need to rock the boat, then let time work its magic, because we'll all be contributing once we start working. And there's a good 30, even 40 years to ensure you have a healthy CPF balance. That's what I would do. So personally, even though I'm self-employed, I still contribute my CPF because I'm just going to let time work its magic. Okay. Maybe next round I should show my CPF balance to show you how time works. But let's just say you rarely can see compounding impact over 8 to 10 years. You will see an impact. Yeah.